Let's ask my next guest how the earnings season affects stocks. We have Dan Weiner. He is the co-founder, chairman, and chief executive of Advisor Investments, where he oversees more than $2 billion of client money. Dan, always a pleasure.
Thank you.
So, when you take a look at the cycle that exists, not only in terms of the market, but in terms of corporate earnings, you see this big move, right? There was this big move up in stocks as we started to get into the earnings season. Now we're right in the sweet spot, right in the middle. Earnings season continues. Stocks just kind of trading back and forth. Seems as though the market wants to go up. What are you talking about when you talk about market timing? Because you've written recently about it, that it's just a fool's game to try to do so.
Well, market timing absolutely is a fool's game. But, you're talking about earnings. There's been a lot of talk lately that the market may have gotten ahead of earnings, that earnings are at a peak, and they are. If you look at earnings, say, as a percent of GDP, right? We're at over 10% GDP in terms of after-tax earnings. So you're way above average. Our average is around 6%. Earnings growth will come down, margins will come down, but that's not necessarily a bad thing. If you think about it, why are earnings margins so strong right now, profit margins? It's because companies have been in this expanding economy, but they haven't added people. They haven't added wage earners. They have really been very efficient about how they've run their business. Now, suppose their margins come in. One of the reasons their margins are going to come in is because, guess what? They've got to open a new plant. They've got to bring on some more workers. It all will redound to the economy. We're going to have more workers. We're going to get more paychecks. We're going to see earnings grow, but the margins may slip. And if people are looking at corporate earnings and just saying, oh, all I care about is the margin, they're going to be disappointed. But if you're looking for earnings growth and sustained earnings growth, we think there's more there.
So do you think that there could be a battle going on between what the professional investor or indeed speculator trades on versus how the economy is going to be doing? Because if you say that there's going to be hiring, that's good for the economy. Greater wages, sure. More money in the economy, more spending. But on the other hand, as you say, if people are looking for margin expansion, they may not get it, and that could bid down the price of stocks.
If anybody's looking for margin expansion at this point, they're playing not last month's or last year's game, they're playing the last 2 years' game. Margins are already huge. We already know that. The question is, how much can companies grow their top lines, and how much are they going to have to begin to eat into the margin in terms of hiring? I think they begin to hire. We saw great jobs numbers last week. The end of last week, we saw that there was a lot of hiring going on. We see more of that. Margins will compress, but that doesn't mean that stocks go down. Large stocks in particular still very, very well undervalued relative to other stocks in the market. We've seen risk off, we've seen or risk on. Small caps have done well this year so far. The big caps have suffered a little bit. They're going to come back. They've got the dividend yields and they've got the earnings.
I'm glad you mentioned dividend yields, because I know that one of your recent reports you talk about selecting the kind of fund to put your money in. And you're saying not necessarily just equity growth, but you want to see dividend growth as well. So it's not just the capital gains. You want to see those dividends, too. You want to get paid.
Yeah, and it's interesting. Investors often look at mutual fund names and they say, gee, if this fund is called dividend growth, it must mean that I'm getting a big dividend. Well, that's not the case. There's a fund at Vanguard. Don Kilbride at Wellington Management runs it, called Dividend Growth. He's interested in what I call battleship balance sheet companies. These are companies that have super strong balance sheets and have the potential and often the desire on the part of the corporate management to boost their dividends.
And not a lot of companies in the fund, right? I mean, he concentrates. What about 50 stocks?
About 50 stocks. And, he's got ADP. He's got Johnson & Johnson. It's diversified, but it's all bottom up. He's looking at these things from the bottom up. He says, are these strong balance sheets? Are these big companies? Have I talked to the managers? Do the managers have a desire to both grow the company and grow the dividend, return something to the shareholder? So you're not getting the highest yielding stocks, nor are you getting, say, the highest yielding fund, but you're getting a concentration of terrific stocks, and the fund's done fantastically, beaten the market, beaten its benchmark. I mean, I don't know how many ways you can say that he's done well.
I want to bring into the conversation Charles Biderman. Charlie Biderman is the chief executive of TrimTab's Investment Research. It tracks U.S. stock market liquidity, including mutual fund and exchange-traded fund cash flows on a daily basis. Charlie Biderman, good to have you with us. Just talking to Dan, he seems a little bit upbeat about corporate earnings. I'm going to get to Europe in a moment. What correlation do you make between the performance of U.S. companies, their corporate results, and movement of stock prices?
Well, we look more at supply and demand of stock and money as more important, in our opinion, than earnings. So what we're seeing as last year, as the S&P topped 1,300, we've seen a slowdown in buybacks and cash takeovers of public companies. And we're also seeing a dramatic pickup as we're halfway through earnings season, or a little more. We're seeing a huge pickup in insider selling the past few days, or week, actually. So we're seeing indications that the only money coming into the market is from float shrink. Retail has not individuals have not put money into the market all for the last year. Pension funds are taking money out. Hedge funds are not buying U.S. stocks. Only one source of cash for U.S. stocks, and that's float shrink by public companies. And if they're stopping to buy as much as they have, and insider selling is picking up, it's beginning to look a lot like last year.
So, Charlie Biderman, is the reason they're doing this, do you think, have anything to do with what goes on or doesn't go on in Europe? Is that one of the overhangs in the market?
Well, what's going on in Europe is a mess, and it's a long-term train wreck happening in slow motion. And there's no solution in sight. All they're doing is playing kick the can down the road, and hope that by the time the can stops rolling, the current politicians will be out of office. Germany is playing hardball, and I hope they continue to play hardball, meaning that unless they see real reform in the budgetary process and the way Europe is run, they're not going to put their money up. I hope they continue that.
Dan Wiener, insider selling, as Charlie Biderman notes. You talk about corporate stock buybacks. They're also slowing. And then you add into the picture what is or isn't happening in Europe. Is it that people are just fatigued by all three of these items, and as a result, they'll still buy stocks? Who's buying stocks?
Well,
Charlie's right.
Number one, they're fatigued, but number two, as Charlie knows better than anybody, the investor tends to lag well behind the market. He said that flows have been out of stocks for a year. They've been out of stocks for almost since 2008. I mean, there has really been, at least in the mutual fund ETF arena, there's been very little inflow. Most of the money, if any, has gone in. It's been into emerging markets. As far as Europe goes, I think that Greece is going to set the floor. Greece is going to set the standard, the benchmark, if you will, for what happens around the rest of the Eurozone. And I agree. I think that the Germans are playing very hardball here. Because they have to, because they know that once they get an agreement with Greece, whatever it is, this is going to set the floor for Portugal, for Spain. Hopefully we don't get to Italy.
Charlie Biderman, what do you make of last week's jobs report for the United States? Is it possible that investors in U.S. companies will do better than those that seek returns outside the U.S.?
Well, just one comment. In Europe, I think there's a basement beneath the floor. So they might be at the first floor, but there's basements beneath them in Greece and Portugal and in lots of those countries where it's just going to be a rolling train wreck. And talking about the jobs report, to me, is very suspicious. As you know, we track income tax collections. We have for 13 years. And income tax collections indicate that wages and salaries are not growing net of inflation, and that the job market, unless people are getting jobs who are all making minimum wage and they got laid off making twice as much money, we just don't see any way that there could be 243 seasonally adjusted, not real. This is estimated. Actual jobs were down 2.7 million for the month, and they're guessing that that's a lot and shouldn't have been that much, and so there's 243,000 more jobs, but who knows?
So, Charlie Biderman, I'm guessing that you're bearish on the market.
We're cautiously bearish. We turned cautiously bearish about a week ago. The only thing bullish is the Fed keeps printing $100 billion each month to subsidize the economy. Europe is now printing big money. The ECB is creating money. And so other than money creation, that's the only bullish thing out there that we see.
Dan Wiener, is it possible, though, that all this money creation will benefit investors because asset prices, particularly stock prices, will rise? It won't pay to fight the Fed or other central banks.
It never pays to fight the Fed, and also maybe we'll get a little inflation in here. Wouldn't it be nice to see a little bit of inflation?
You want to see that 2% that the Federal Reserve is talking about?
We're already over that. The PCE is at about 2.4%, but we're not feeling it, right?
Including food and energy, it's closer to 3.
Well, that's the CPI. The CPI is at 3, but the Fed actually said last month that they are now looking at the PCE. They're looking.
Yeah, but people spend money on food and energy. So if food and energy is up, the cost to people out there who earn a salary is up too. So
no,
I understand
right.
the Fed uses
and that's the PCE has food and energy in it. This is not.
And
the
you'd
core.
like to see a little inflation because that means there's some economic growth.
Absolutely, absolutely.
We got to leave it there, a bull and a bear. Thank you very much. Dan Wiener, Advisor Investments, and Charlie Biderman, Market Trim Tabs.